So this is topic 2. Yeah, it's visible now. The topic is financial statements and ratio analysis, and I reiterated here that this is the basis of your first assignment. So please make sure that this topic will provide you the intellectual backup, but the instructions, how to do the task, font size, all the practicalities, they are available in the folders, in the assignment folder, where you can see all the instructions that how you will be presenting. And I strongly suggest to you that those who will be doing this task in the group, they must do some proper rehearsal and group dynamics. If suddenly you divide, all right, we have 5 different parts of the task, we are 5, let's take one each. And an hour before the presentation, you make one file and you are here, 5 of you. Believe me, you will fumble, falter, and the performance would be not up to the standards. So please make sure that you have done enough of rehearsals, the dress rehearsals, So make sure that you do it a couple of times. The background of the financial ratio analysis is very important. They have been in use for many, many years. But 1928 was the Benjamin Graham, he was a teacher of Warren Buffett. And he's the one who popularized this concept that, hey, you know what, if you want to understand the stock price changes, that how the market behaved, it's very important that we should also do some data analysis of the company's financial statements. There is an underlying difference when you do the ratio analysis and the stock price analysis. I can call ratio analysis, and instead of using the stock price analysis, I can use the phrase market analysis. The market analysis is futuristic by nature. When you see that a company's stock price has gone up from 12 euros to 20 euros, it shows that the company's future is promising. The product or the services which this company is making have more in demand, the cost is going down, revenue is going up. So all the goody things which you can associate with the company, you can. So when you see the company's stock price changing, it is a futuristic. However, when you do the ratio analysis, you are digging the graves. You go to the company's previous financial statements. Look, we are in 2019. And in many cases, we don't even have the financial statements of 2018 yet because they're not published. So we are looking backwards. So there is a difference in the stance. When you see the market, when you do the data, the market analysis, you are forward looking. But when you do the ratio analysis, we are backward looking. But don't forget that history have an impact on the present, and the present have an impact on the future. History teaches us lessons. It's a different matter. We never learn from them, right? But this is a nice data digging that we can see that how the company's performance has been in the past. So it's very important that when you learn, this topic is not in isolation. The reason this topic is that, as I said in the very beginning of this course, that I will not reckon you students in this semester. For this course, you are the trainees. Trainee of a fund, wealth management. And here, your job is to give a consultancy to the clients, to the investors. But in this category, in this course, I fit you more. I fit you more in the fundamental analysts. The fundamental analysts are those people who look at the company's history, dig deeper into the past data, and then make some conclusions, and then they provide some consultancy to the investors. However, in my other course, which is nowadays going simultaneously, financial management, I treat my students as the technical analysts. So in that course, I never tell them that dig the graves. No, 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 no. Forget about the past. Forget about the statements. See what's going on in the stock market now and make some forecasts for the future. So there is a very difference in the nature of these two courses. Some of you have taken, and I'm very happy that you have taken some of you. I can understand that you have some time constraint, but maybe if you can't do it now, you can do it in the next semester. So yes, so there's a transition that in this course you study. In the economics, you study the overall situation, that how the business corporate environment looks like. You should be able to understand that how inflation, interest rate, GDP forecast, the markets going down, up, the political statements, things going on in all over the world, how they can affect you. So that was a very general course, but now you are going from more general to specific. And in this course, I treat you, once again, I'm saying, I treat you as the fundamental analyst of a fund management, that you people are taking care of wealth of millions of. Bilal, you know that we started this project, so that's exactly what we. So in this course, you are working as the fundamental analysts. All right, who believe, I told you last week that when you enter a company's office, a fund manager, those who maintain millions and billions of dollars on daily basis. Do you know how big is the financial world? Any guesses? Any idea how big is the financial world, global financial market? And I'm not saying the market size, I'm saying how much worth transaction take place in the financial world on daily basis. Any idea? Is
there a record of it?
Well, there is a record I can share with you, but any guesses? Huh? It's $5.3 trillion a day. On daily basis, the financial transactions all over the world, and I'm not including those countries where the data is not available from. I'm only counting those countries whose data is available. It is 5.3 trillion on daily basis. And usually there are 250 working days in a year. So kindly multiply 5.3 with 250. If you can find some numbers, please tell me. I couldn't find out. So yeah. So therefore, it's very important that you need to understand that how accounting, finance, economics, all these things are connected to one another. They are not in isolation. The gentleman who developed this concept, this Columbian Business School professor, Benjamin Graham, he was a teacher of Warren Buffett, and you know Warren Buffett who he is. Financial ratio analysis are used to assess the company's performance. Ever since the stock market, the modern day stock markets were formed. I'm saying modern day stock markets were formed. Stock markets even existed in the prehistoric time, but then it was a different form, right? But the modern stock exchanges, I couldn't read it, but the first book about the stock market which I discovered was published in 1716. Unfortunately, I couldn't read it because it was in Dutch. So the Amsterdam Stock Exchange, it's all about that, how the financial instruments are traded in Amsterdam Stock Exchange. Okay, so this modern stock exchanges have a very long history. The characteristics. The financial analysis, the analysts, they analyze the financial statements in the light of global development. So whenever you are doing some data analysis based on the company's financial statements, you must keep your eyes and ear open that what is happening in the market. All right. So some ratio can be very nice, but the financial climate can be very bad. You have a reason to be worried. On the other hand, some indicators could be pessimistic, but the global market situation is very promising. Well, don't worry too much. So it's very important that you see these numbers in the context, but as the discussion follows, things will become clear. Financial ratio analysis help you to advise your investors what to buy, what not to buy, what to sell, what not to sell. So basically, in this course, you are training to be the consultants. And I copied one link. I wish if it could work. Just today I came across this BP, the British Petroleum. Yeah. I'm not sure how easily you can see these bars. Can you see it? I can imagine that if these are the views of some analysts, and let's imagine that these analysts are fundamental analysts like you, who have studied financial ratio analysis. And then they are giving a consultancy advice to the people that, hey, folks, if you are interested to buy or sell British Petroleum shares, we have some information for you. Look at January. There are, you can see that out of total 10, 13, 3, 16, and 2. There are 2 analysts, the top figure. Can you see here, this one? They are saying that, hey, folks, we have done the ratio analysis. We have done the 10 years, 20 years data analysis of BP, financial statement analysis. And we give a suggestion to you that wherever you find, at whatever price you want to, you can get BP shares, get them. And there, look at their advice is labeled as strong buy. Strong buy, wherever, whatever price. If you find BP stock in the market, purchase it. 20 or 18, sorry. They are not very vehement, they're not very strong, not very emphatic, but basically they have the same opinion that buy it. And why would somebody advise you to buy or strongly buy? Because the chances are that the price will go up in the future. So better before it becomes expensive, buy it now, sell expensive. And then there's a group of people. How many they are? 13. They have an opinion that if you have BP, if you already have BP, don't sell it, hold it, hold it. And out of them, 3 are saying to the extent that, hey, they are strongly, they are literally requesting you that don't sell it, don't even dare to sell it. Because, so if you see the overall picture, the greens show that buy it, strongly buy it. The yellows show, if you have it, don't sell it, hold it. None of them is saying that sell it. You can develop a perception about the BP that the BP stock is going to increase. See the beauty. The BP stock is going to increase, expected to increase, is futuristic. And what made you skill, knowledge, information to make this kind of interpretation? Dig deep, historic data analysis. So imagining that these people are the fundamental analysts, they are giving you the opinion to buy the stocks, what to buy, what not to buy. You can see that there is a comparison. December last year, there were some people, can you see? Even though in minority, who were even saying that sell it. And there's nobody saying sell it now. What does it mean? That things have become even more optimistic from December last year to January this year. So when you are considering 2 bars, 3 bars, you can see that how over the months, the analyst opinion is changing. And once again, imagining that they are the fundamental analysts, they would be making these kind of interpretations. That's the idea I'm trying to say, that it's not we're not learning for the sake of learning. This is a serious thing. All right. And what is the connection of the topic we did before? Because in that topic, you have the debits, credits, money comes in, money goes out, you buy asset, you sell with cash, whatever, that would affect your financial statements. So based on the last topic, your financial statements, imagine, gets better. This month, better analysis. Better analysis, better show, you are making a better forecast for the future. So start with a small transaction. You buy some furniture. That can change your whole financial data. All right. I remember I mentioned this concept called ripple effect. That a small a coffee bill paid by $1 billion worth company can change its income, profits, assets, and liabilities. All right. So very micro stream of cash flow can have the long-term impact on the company's performance, longevity, survival, growth. All right. So that's what I wanted to share with you. But let's go back to the slides. Where are they? Here? Oh, yeah. And another thing, why is not? Another thing is that, yes, sir.
Question about that chart. It made in sense that for long term or short term?
Well, it's a monthly analysis, month to month. And in finance, anything less than a year is a short period. Yeah, remember 364 days is a cutoff point. So it's a short-term analysis. So the analysts are giving you views month-to-month basis. But remember, this is a free data, yeah? If we subscribe to Yahoo services or some other consultancy services and we pay some subscription, you can get more daily reports. So this is a little bit kind of...
It would be also pretty daring to give advice for a long term.
Yeah. Well, people do give advice, but then it's a paid database and you have to subscribe. Yeah. I remember I've left this thing now, but once upon a time I used to do it. At that time, I would get even long-term advices also. All right, and the next thing I want to share with you is that sometime the only performance indicator you have are the financial ratio analysis. Imagine if there's a company like BP, is a listed company, yeah? You can show the company's performance based on the financial ratio analysis and the stock price. But what about the SMEs? They're not traded in the stock exchanges. If you see some small kiosk or some small cafe, do you think their stock price is listed in the stock exchange? No way. Then the only way you can see the performance is improving or deteriorating of such small, tiny, mini SMEs, startups, is the financial ratio analysis. Right? We are working for a project in which a big fund based in Jyväskylä is investing in SMEs in central Finland. And the only tool that we have available with us is the ratio analysis. Because those companies, there is no stock price data at all because they are not trading in the stock exchange. So the only way we can gauge, investigate the performance of those enterprises is the ratio analysis. The financial ratio analysis is a part of the overall fundamental analysis. These people believe in history. They are very strong, staunch believers in the history. that history repeats, cycles come, go. We need to learn and then make a pattern based on that. Draw a line. What type of pattern you observe? The stock price is also affected by the ratio analysis. Imagine the company's earnings per share improve. Imagine company's operating profit improves. Imagine company's revenue goes up. Imagine company's assets goes up. Imagine company's liabilities go down, cost goes down. All the goody things happen. What will happen? The stock price of the company will go up. And when the stock price of the company will go up, the company's market value, hence valuation, improve. Imagine all these good things happen, and the stock price jumps from 10 euros to 12 euros. And imagine this company has 10 million shares. Until yesterday, when the stock price was 10, this company was 10 multiplied by 10, 100 million worth company. And today, the company is 120 million worth company. So the market value of the company will improve. The book value will remain same because it doesn't change. It's still in the books 100, but the market value of the company goes up. So if the financial ratio improve, the stock price improves. And when the stock price improves, the company's market worth improves. Okay? Sound sense? If you want, I can show you. Could you see here this data, this figure? Market cap. Yeah? Market cap is this thing. This is the market value or market cap. So it means that the company's, which company, BP, is worth $110 billion. Okay? $110 billion. And how do you get this value? The stock price, which is now, look at, can you see this? Can you see this black dot? It shows the now stock price, the current stock price, multiplied by the number of shares the company has. So the market value of the company can change on infinite times during the day, but the book value remains same. It changes only after 3 months, 3 months, 3 months, 3 months, and you may have the new. But the thing is that the ratio, the beta ratio, have a positive impact on the stock price. Hence, there is a larger value of the company. That's my idea. Okay. I always recommend Yahoo Finance because it's very simple to understand. And if you people have some interest in finance, it's a good source of information, good, nice learning platform. Okay. Believe me, they haven't paid me any commission. Okay, so yeah, so please don't. To many people, the financial ratios are like diagnostic test. It's like you go to the doctor for diagnosis. If the company's liabilities are increasing, the debt is increasing too much, how do you know the company's debt is increasing? You don't see the absolute size of the debt. You see that how the company's debt to the total value is changing. Are you with me? Do you believe in the absolute measures of performance or the relative measures of performance? I'll take a pause here. The company's total capital will come from debt and equity. Debt is the external capital which you have to pay back at some stage to the outsiders because you borrowed from them. Equity is the company which belongs to shareholders who are part and parcel of the company. It's like an internal capital. If a company's debt to the total value ratio is increasing, it means that your liabilities to the outsiders are increasing. One can argue, oh yes, it's a good thing. Maybe the company's growth prospects are so high that the internal money is not enough. So we have to raise more money from outside. Well, it's a good reason. But on the other side, the bad reason could be that there'll be more pressure to repay on the company. So the idea is that when you do the financial ratio analysis, we get some diagnostic test. All the headache is not bad. Like when somebody complains that, hey, doctor, I'm having headache for last many weeks. That headache could be for some excitement because somebody had a good news lately, got 5 grades in accounting, or likewise, yeah. Or it could be a bad reason. Is this headache a good reason or a bad reason? This is a diagnosis. This is a diagnostic test. So when we do the financial ratio analysis, we are able to make a judgment that this change in the ratios over time, is it a threat? Is it a problem? Or if it is a problem, is it going to be a really serious problem, or will it be taken care of by itself? It's only a matter of time. So the financial ratio analysis is a diagnosis of a company. All right. So that's something very important. And there are 3 tests we do, or rather 4 tests we do, like a patient, you know. So the doctor want to rules out any problem. So then the doctor would prescribe, all right, there'll be 4 diagnoses we shall do. The first diagnosis is liquidity test. It could be like if I can use a metaphor, let's the blood pressure. The second could be solvency, the blood count. A third could be profitability, the pulse rate. The fourth could be operations, that can you breathe properly? Is breathing okay? So these 4 tests we use for a company. And then we get the results. And then we make an overall report that, you know what, this is fine. Liquidity is fine. Profitability is fine. Operations, maybe you can improve. There's some room for improvement, but you know what, I'm concerned about your solvency. And then the patient, that's the company, ask you, what should I do then? Then start the treatment. Financial ratio analysis are paving the way for the corporate restructuring. I can call it treatment. All right, so this is a very crucial topic. And most of the data for this task will come from basically 3 statements. We have done 3 statements and we shall stick to 3 statements. The income statement, the balance sheet, the overall assets, liabilities, and cash flow statement, how much cash you have. You can have huge amount of profits, but your company can be starving of cash. So we shall be using these 3 data sources of the chosen company. And I assume that you have chosen your companies already, except for the BP. Don't take that. The users of financial ratio analysis, who use them? Well, there are many people who use them. Majorly the financial analysts use them, investors, the existing and the prospective, the would-be. The company managers use them because they have to give a presentation to the board of directors, all right? And not all the board members are savvy to the accounting data, financial data. So you need to give a presentation. But believe me, they can ask you difficult questions. So you go prepared. Regulators can check. For example, how to say regulators? those bodies, the central bodies, the big, who are taking care of the company's financial markets, the capital market. They, for example, the best name I can say is the Securities and Exchange Commission of the USA. So these bodies are checking that which companies have paid taxes, if you have shown losses, how much credit they should give you, right? Controllers, the internal and the external, there's some external controllers, and then the company employs some internal controllers also who takes care of, if your cash ratio is going down, it could be that you are wasting lots of inventory. You don't take care of your raw material properly. So they can give you advice that, you know what, you shouldn't waste your inventories. Suppliers are interested. If I'm a supplier of a company, I haven't supplied goods yet, but some client comes to me and asks me, Mr. Supplier, can you provide me the raw material? I haven't dealt with this company before. The first diagnosis I would do is check their financial performance. And if your cash ratio, if their cash ratio is dismally low, I would never sell anything to this company because they are already suffering from cash shortage. How would they pay me? How would they pay my bill? I would stay away from this company. And same way, even as a customer, I would look at the financial ratio. Imagine I buy a car. The car would be a long-term asset for me, right? I need the after-sales services. I may need the spare parts also. But when I check the financial ratios of the company, their solvency is very poor. And I have a good reason to believe that this automobile manufacturer may become bankrupt. So if I have Renault, I will not buy from Ford. How would I get the spare parts then? You get my point? So those suppliers, customers, they do take into account the company's finance. So it's not only for the financial analysis, even for the normal purchase, you can use it. And of course, we use the researchers and the students, they use these ratios as well, like you are using in order to get your credits. ECTS, 5 ECTS. The usage, the main purpose of the financial ratio analysis is to derive the true, objective, comprehensive, detailed financial health snapshot of the company. The basic idea is that you are able to gauge the exact financial health of the company. All right, that is the main purpose. We don't do it for fun's sake. We have a very clear reason that we want to see how much is the company, where does it stand. Okay, I just pick up some words. An investor would be interested in the statements of comprehensive income and the availability of profits to pay dividends. Can company pay your dividends? Whereas a credit controller of a supplier would be interested in the customer's ability to pay. I will never sell as a supplier any inputs to a company whose cash ratio is shrinking. Okay, so we all have some reasons, right? So as I said, it's like a health check. When you go for your health check, you have a detailed, reports. Some of the results are important, some are not important, but they may be important to different people. Okay, maybe customer. If I'm a customer of some company, I'm more concerned about the solvency of the company, whose product I'm buying. But if I'm selling to somebody and I'm a supplier, to me, their liquidity, their immediate payment capacity is more important than anything else. Okay, and if I'm a lender to a company, again, I would see how much the company's value is already in debt. I would never give loan to a company who is already net deep in debt. Because if this company becomes bankrupt, those who lent it first would have the first claim, and I would be having a junior claim over the dead company. So I have a chances that I would not get anything back. Why should I take this problem? Why should I take this, invite this wrath in the very beginning? Why should I do it? I can simply refuse the loan. I'm sorry, unfortunately, I cannot give you loan due to some, I don't have to say that you're a bad company or you have very bad future. I shouldn't say it, but I can refuse. that maybe my superior have refused your loan, so I can pass the buck on to my senior. Who cares? The mindset. The mindset when you calculate is that adopt a critical perspective. Come with the sense of suspicion, not that you are behaving like an investigative journalist and you are always, very kind of, you believe in the conspiracy theories, but come with the pinch of salt. Take the numbers, take every information with a pinch of salt. As this topic progress, I would show you several examples that how the data can be manipulated with the help through the financial ratio analysis. So you need to see the things because you are not lay people now. I assume that your training has already been progressed. This is your 5th, 6th lecture now. So I would assume that you will be taking these things more seriously. The mechanism is that the current performance of a company is compared to its past performance over years. And this is called horizontal analysis. Can you recall that in some of the previous lectures, I showed you the income statement? And there were 3 years, 17, 16, 15. So what you do, you compare the company with itself for different periods. All right. And if you go to the same company's archives, you can even find the 4th year, 5th year, 6th year report as well. So all the data are available. So when you are comparing the company with itself, but over multiple periods, it's called horizontal analysis. And the second analysis is called vertical analysis. The vertical analysis that you compare a company with a competitor for a given year. So the year don't change. The year is one. But in 2017, you are comparing BP with the rest of the industry. All right. In your task, which you will be doing, that would be more like a horizontal analysis rather than the vertical. But if somebody can bring some flavor, but I would not say that you do it. But I would confine it to horizontal analysis. The vertical analysis is also possible, but I want to show you a link, basically, if it works. I just took these all are, if you look at the left side, the valuation ratios, the price to earning, they all are ratios, by the way, yeah? Price to earning, price to book ratio, price to tangible assets, or if you look at the company's other indicators, the current ratio, the long-term ratio, the debt ratio, right? And then you see that it's company, industry, and sector. This is a vertical analysis. Because for the same year, the BP is compared with the rest of the industry. The year don't change, the year is same. But a company is compared with the peers, the others in the market. So BP is compared with the average of all the companies in the industry. So I can say that, for example, the current ratio. How much current money BP has? BP has a problem. Whereas all the rest of the companies in the industry, which industry? The oil industry, have lots of cash. Look at the ratio is over 1. BP is having 25% less than them. So I can see that very visibly that BP has a problem. It's quite a big problem actually. It's 1.85, the others. Yeah, 1.85. And BP has only 0.73. So BP has nearly less than half of the cash resources, basically, than the rest of the industry. And who are the other players, the major players in the industry? Well, there is Shell, there is Chevron, there is Total, there is Occidental, and maybe a few more. And plus some small players. Okay. In Houston, there are many oil companies. So there are some small players as well. So overall, when you compare BP for the same year with its competitors, the ratio doesn't. This is a vertical analysis, right? But in this course, you'll be doing horizontal analysis, that you'll be comparing company with itself, but for the multiple periods. I think I discussed in the instructions that you'll be considering 5 years, last 5 years. So if 17 is the first year, then 17, 16, 15, 14, 13. So 5 years data analysis. All right. But when you do the comparison, couple of things you should be careful. Well, actually, this point is less relevant to you because you will not be doing the vertical analysis in this assignment. But why this is important? Because if you want to compare, let's say I want to compare BP and Total. Now, BP is a British company. Total is a French company. They both are the oil companies. But when I compare them, I should keep in mind that are they following same accounting standards? Because it could be possible that one is following IFRS, which is a kind of international standard, and the other is only following UK GAAP. Well, you don't have to remember. But point I'm trying to make is that it could be possible that the companies you compare with each other, they are following different rules and regulations. So then the comparison becomes absurd. The second is that how the formulas apply. Different accountants sometimes employ different formulation, the formulas. So you will see soon that sometimes you can use different formulations for the same thing. So that could also be a problem. And same way, you have to compare the institutional background also. You can't compare a for-profit company with an NGO. NGOs also make financial statements. The for-profit companies also make financial statements. You can't compare them because they have a different mindset. The institutional setting is so different from each other. All right. Same way, if the company is a public sector organization owned by the state, again, the things are the way the company is treated in terms of taxation and subsidies. The state companies are always preferred over the private. They always get a preferential treatment. And again, the comparison becomes a little bit awkward. So you make sure that you only compare the private with private companies, public sector with public sector companies. Okay, please be careful when I use the word public. Public company and public sector company is not same. Can somebody tell me the difference? The public company and the public sector company is not same. Mm-hmm. Yeah. Public sector company. Mm-hmm. You're right. The private company which raise money in the public market, like stock exchange, is called a public company, even though it's a private company, but it's a publicly listed company because the public can invest in that. But the public sector organizations are owned by the state. They may also be listed, by the way. But then the state always owns the majority share, right? So there could be some subsidiaries started by Ministry of Defense to make some tanks, for example, or some hospitals opened by the Ministry of Health. These are public sector undertakings. Public sector automatically underlines the state ownership and control. Whereas the public companies, most of them are actually private companies, but public is taking part in their, investment related matters. All right, so the data which the ratio analysis that you do could be headline or published or self-calculation. And you can see this is a nice link. I would recommend you that you all should subscribe to this. Morningstar is a fantastic source. of pre-calculated financial ratios, right? But I will not make your life so easy. You can't just go to the website, get the data and get credits. No. Don't you know me? You will be doing all self-calculation thing. But just for the sake of your knowledge that this is a very nice, and I have been using it ever since I was a student, Morningstar. They changed the name, but they provide very comprehensive data when it comes to the ratios of the companies. All right. The next thing I want to discuss with you, oh, not this one, is that the financial ratios are based on numbers. Yeah. A number in the numerator, a number in the denominator. Outcome is also a number. Quantities. Numbers themselves are dead. They don't speak. You have to make them speak. You have to fill in some oxygen so that those numbers can speak and tell you some story. And then comes the word narrative. Narrative, storytelling. You have to make interpretations of those numbers that it makes some story. It gives you some information. It gives you some piece of news. So this is why, as always, and this is very clearly mentioned in your instructions in the assignment, that when you do the calculation, I will not check with the calculator that how correct your calculations are to the third decimal point. Of course, I would give you discredit for the wrong calculations, but what I would be very interested, or rather majorly interested, is that how those numbers are interpreted and what type of implications, what type of conclusions you draw, and how you give a suggestion to somebody. It could be your managers, senior managers, the board of directors. It can be your investors also. So the three mantras in this task: calculations, interpretations, implications. Calculations should be correct, but that's not the everything. Interpretations. What type of information you draw from these numbers? Implications. What future advice, consultancy, suggestions you give to somebody? As I said, it could be your board of directors, your senior managers, or it could be the people who are interested to invest or sell their investment. Three things: correct calculations, but that's not everything. Correct interpretation or multiple interpretations. See the different things. See the bigger picture. Like, for example, I told you here that if a company's debt to the value ratio improves, it gives me two pieces of news. The one positive news, the positive interpretation I can draw is that, hey, company has such a promising future that the internal money is not sufficient. And this is why the company is borrowing. All right, this is one interpretation. The second interpretation is that, you know what? The company is heading towards a problem. And the problem is that with the more debt in the total value, the company will be under more obligation to repay its debt and the interest. And this can put the serious strain on the company's cash flow. Now imagine, these are two interpretations, right? Please tell me, if this is the case, what should I do next? I see the company's debt to value ratio going up, and I still haven't investigated. I know that, okay, this number is 0.7. The good reason is that the company is going for head-on, the company is going for more investment. The bad reason is that the company may have some financial crisis in the future. These are the interpretations. What is the implication? How and when and in what way I can draw the implication? Yes, sir.
More research that which one of the situations is more likely or true, and
yes.
Then make an implication.
Fantastic. Fantastic. So this gives me interpretation, give me a suspicion. You know, when you're a cop and you know that the guy who committed the murder is somewhere here in this area, but you can't, not here, I mean, I'm just saying, you know, yeah, I believe your honesty and you all are innocent, okay? I can give you clean sheet any moment. So first of all, the corner, that this is the area where this person is, the one who committed the crime is here, but they don't put everybody in the jail. Then they do the further investigation. And then they find, hey, you know what, the next stage, not the full area, but in this street. So then the corner of the street, and then from the corner to the house and to the exact person. So this is a good point. If I have a doubt that this increased debt can hamper company's solvency in the future, company can become under crisis, then I would check the cash ratio. And I found that the company's cash ratio is going down. And then I find, all right, is this debt used for buying more assets? And when I find that assets are not really increasing. On the one hand, the assets are not being bought. And on the other hand, the cash ratio is deteriorating. I have a strong reason not to believe the positive outcome, but to believe the negative outcome. This is called implication. And hence, my implication would be that the company should reduce its debt ratio as soon as possible. So I repeat, the first point would be, of course, calculation. The second point would be interpretations. You can have the multiple interpretation, and don't stop yourself. Always see the bigger picture. Don't get yourself enslaved by the pre-existing ideas. Think as deep and far you can. But then with the round 2, round 3 research, you can say that, you know what, I think this is either a good news or a bad news. So that's your job should be. Like, for example, when you see these ratios, these numbers, the company's net profit doubled in 2013, and then it doubled again in 2014. And so are the company's assets, or the total capital, right? And the return to capital, that is second column divided by the third column, is 10, 10, 10. It seems that the company's performance has been stagnant. Do you get the idea? If you see the 12, 13, and 14, you find that the company's performance has been throughout same, 10%, 10%, 10%. But this is the quantitative analysis. You need to do some qualitative analysis also, where you bring some narrative. The narratives are missing. The missing narrative is that the company is continuously improving better. You know, after all, you double the profits, right? This aspect is hidden in this 10%. It doesn't acknowledge. The second part could be that are these profits more because of cash sales or the credit sales? I mean, I can improve my profits by making grand sales on credit. I don't even check anybody's credit worthiness. So anybody who comes, just buy and say, Shab, I will not pay you now. Okay, don't pay me now. Come later, no problem. Who cares? So I am on the mission of increasing my sales revenue. My profits are increasing. But I would be having a long-term problem when those clients are unable to pay me. So what is the reason? What is the agenda behind it? It's missing from these. So then that you need to explore. The third thing is that, has capital structure of the firm changed due to increased size? Is company really increasing? Look at the capital size. You are doubling the size of the company. Does it show that the company has very clear, tangible growth prospects? Or is this company is over ambitious, over optimist? Right? Remember the phrase we discussed in the last semester, irrational exuberance. Who will say irrational exuberance 10 times in 10 seconds? Isn't it tongue twister? It sounds a tongue twister. So, so the point I'm trying to make is that, do you have a genuine reasons to expand the firm size? Or is it so that you are doing it because you want to be on page 3? You want to be in the headlines of financial media. Oh, look at this person. He's a corporate czar or some kind of, whatever word you can use for yourself. But this person is really on mission expansion. Okay? Because many CEOs or many big managers have this problem that they want to write the name in the history books. And in order to do this, write the names in the history books, they commit they behave like the corporate emperors, expansionist, right? Like those countries who were once, who believe in colonialism, buy more companies, increase the size of the company, okay? So that I'm remembered that how many company I bought during my tenure. The company can bankrupt, but only after I retire, so that I can put the blame on the new manager. Okay? So, or is it the reason that the company really have very promising future? What is the reason the company size is doubling on year basis? All right. So this you have to explain with the help of a narrative. So that there comes the story, there comes the sentences, there comes 3 out of 2 requirements of the task: interpretations, implications. Interpretations and implications you can only do in sentences, right? So make sure that when you do this task, you also make the data interpretation properly. Okay, so the financial ratios are incomplete without narratives. Have a good story. Don't you think we should take a break now? Well, not many people said that we should take break. So I changed my plan. Who said?
Ask it again.
Should we go for a small break?
Yeah.